Hello, my name is Crystal Dahl, and I'm the Online Communications Specialist here at Meritas. I would like to welcome and thank each of you for joining us on today's webinar, India Insights Series, Part 1, Taking Stock of the Indo-US Partnership. Before we get started, I would like to quickly go over a few housekeeping items. Meritas now offers the ability to listen to our webinars through your computer speakers. If at any time you have any difficulty hearing the presentation, you may call into the associated telephone line instead. All phone lines will be muted. If you experience any technical difficulties, please press *0 at any time to connect with a support technician. Since you will be muted, if you have a question, please ask via the chat feature found on the left-hand side of your screen. Questions will be answered at the end of the presentation. Lastly, in the next few days, I will distribute a copy of the presentation, a recording of the webinar, as well as each of the presenters' contact details. Our presenter today comes from the Meritas member firm in India, Khaitan Co. Khaitan Co is one of India's largest full-service law firms. They have an active U.S. desk and are involved in many of the marquee cross-border transactions and investment deals in India. Ashutosh, would you like to get started?
Yes, thank you, Crystal, for the kind introduction and providing us with this platform. Everyone, welcome to this webinar. The discussions today are meant to serve three primary purposes. One, help you gather a deeper understanding of the opportunities in India. Second, analyze the M&A landscape here. And lastly, red flag a few of the critical issues pertaining to taxation, litigation, white-collar risks that need to be kept in consideration. We have broken down today's program into two broad segments. We will first take you through a short presentation to set the context, which will be followed by an interactive panel discussion to address your thoughts and concerns. We are all aware of the increasing convergence of economic and political interests of India and the US, which is evident in the growing proximity between the two countries. The widely publicized India growth story has opened a whole host of opportunities and growth possibilities. India is today widely projected to become the world's third largest economy by 2030 and has been the world's largest recipient of FDI inflows over the last 6 months. In order to leverage this global interest, the new government in India has taken a pro-business and growth-centric stance. From modernizing some of the archaic labor laws to ensuring enforcement of global quality norms, there is an ongoing push to deepen the country's integration with global standards. Let us put this growth in context. Post the liberalization phase of early 1990s, IT and technology sectors were really the harbingers, closely followed by significant investments flowing in manufacturing and pharmaceutical sectors. Several automotive manufacturing facilities in India won the prestigious Demings Award, and India-based generic drug manufacturing for Western markets really took off. Next came investments in infrastructure and resources sector. This sustained period of growth really led to easier availability of capital and created a wave of consumerism, which is now fueling India's economic growth and creating widespread consumer demand. Earlier reforms helped strengthen the services sector in the country, while the current wave aims to resurrect the manufacturing sector. A clear mandate to the new government in the latest elections provides a carte blanche to drive an unhindered growth agenda. There are several ambitious multi-billion-dollar projects that the government in India has launched. Make in India is the flagship program meant to create an enabling ecosystem of commercially sensitive laws and balanced policies to ignite rapid growth across several industry sectors. These programs are targeted at promoting local manufacturing by multinational and domestic companies and creating long-term capabilities in India. Seen in the larger context of improving Indo-US relationship, it stands to reason that US companies can have a major role to play in helping India meet these objectives. Government's policy push has also led to robust growth across certain specific industry sectors. As an example, the recent spate of reforms in defense and insurance have catalyzed foreign investments in these sectors. Tax incentives and India's push toward clean energy have similarly led to rapid growth of renewable energy as a key growth sector. Some of the other sectors witnessing this kind of rapid growth in India are pharmaceuticals, healthcare, FMCG. As I have alluded to earlier, ongoing reforms are essentially meant to create an investor-friendly operating environment. Government has relaxed FDI limits in majority of sectors. They have relaxed the industrial license regime with regard to different industry sectors. There also seems to be a dawning realization regarding the need to establish systemic protocols for protecting IP and for fostering corporate governance. The revised Companies Act 2013 in India is a great step forward in this regard. Government's stance on ending tax uncertainty, as seen in the latest instance on the issue of applicability of minimum alternate tax on FIIs, as well as its efforts to create a unified Indian market through a pan-India goods and services tax, are noteworthy and have been widely welcomed by the domestic and foreign industry. Increasing exuberance in Indo-US relationship is, however, still tempered with apprehensions about the ease of doing business in India, transparency, predictability, and legal certainty. Alleviating these concerns will go a long way in providing a fillip to the bilateral trade. Having said this, let me now invite Rajat Mukherjee to share his views on the transaction activity in India. Rajat is a partner in our corporate practice and focuses on M&A, joint ventures, and corporate cross-border transactions. Rajat, over to you.
Thank you, Ashutosh. I will try and use the next 8 to 10 minutes to try and give an overview of the foreign investment regime in India and cover some M&A deal issues. This slide, the foreign investment regime in India is governed by the Foreign Exchange Management Act, or the FEMA, and the regulations notified thereunder by the Reserve Bank of India, read together with the consolidated FDI policy, which is issued by the DIPP, or the Department of Industrial Policy and Promotion. Basically, foreign investment is permitted in all sectors in India except certain prohibited sectors such as atomic energy, gambling and betting, and real estate business. In certain other sectors, foreign investment is capped to a prescribed threshold. For example, print and media, where foreign investment is capped at 26%, or multi-brand retail, where it is capped at 51%, private sector banking, where it's capped at 74%. Sectors which have caps either fall under the automatic or the approval route, which basically means that for these sectors, you will need government approval or not. So, for example, foreign investment in the defense or print media, any foreign investment requires the approval of the government, which is granted by the FIPB, or the Foreign Investment Promotion Board, and which is an inter-ministerial body set up under the aegis of the Ministry of Finance. In addition to equity investments, Indian companies are allowed to raise debt from overseas lenders subject to compliance with the ECB or the External Commercial Borrowing Guidelines issued by the Reserve Bank. There are various conditions attached to them, including guidelines on eligible borrowers and lenders, permitted end use of funds, maturity period, etc. Recently, the Reserve Bank has allowed Indian companies to raise rupee-denominated debt from overseas lenders, and these do not have to comply with many of the limitations that the typical ECB guidelines have. If you broadly look at how a foreign investor can set up presence in India, it can be if you have a limited duration or for a particular purpose, one can think of setting up a branch or a liaison office, but setting up a branch or a liaison office requires prior approval of the Reserve Bank, and there are limited things that one can do under a branch or a liaison office. The most common form of creating presence a long-term presence in India is by either setting up a subsidiary or by investing in an existing Indian company. Such a company can either be a private company or a public company, and a public company can either be a public listed or a public unlisted company. There are other modes through which foreign investment can be made, which is either through a investment in an LLP or in partnerships, both of which, however, require prior approval of the Reserve Bank. In terms of M&A and M&A structures that are relevant in India, basic M&A structuring and documentation in India is not unlike the United States or the UK. Of course, there are various nuances which are particular to doing deals in India, but on a broad structural level, deals are either stock purchase or asset purchase transactions. Asset purchase are of two types: a slump sale, which means the transfer of a business undertaking as a going concern, or an asset purchase where individual assets are identified and cherry-picked under an asset purchase agreement, with individual considerations being allotted to each asset being transferred. Any transfer of property attracts stamp duty in India, and the amount of stamp duty payable often drives the transaction structure. So, for example, if you have a significant amount of real estate that is being transferred, often the amount of stamp duty payable on that real estate transfer will drive the transaction structure. Unlike the United States, mergers and demergers are court-driven processes in India and not just contractual arrangements. The court process involves holding a meeting of the shareholders and creditors of the entities involved in the merger and approval of the scheme by a 3/4 majority by both shareholders and creditors. It is a fairly time-consuming process, and depending on the location of the entities involved, could take from anywhere between 4 to 10 months to complete. The advantage of the merger, of course, is that one entity ceases to exist after the merger. However, triangular mergers or reverse triangular mergers, which are fairly common in the US, don't exist in India, and one only does forward or reverse mergers in India. Moving to deal activity in the recent past in India, it's been very active. Ashutosh mentioned some of the steps that the new government has taken to allow greater foreign participation in India, both from an M&A and a private equity deal flow perspective. We've seen more deals in the first 6 months of this calendar year compared to the previous year. Some of the sectors which have received maximum foreign investment are pharmaceutical and healthcare, e-commerce, financial services, and energy and natural resources. Increase in private equity deals have been largely driven by the interest in the e-commerce sector. So this is private equity and venture capital. The attraction of the sector is fairly obvious given India's large population, which is growing exponentially in terms of migration to being online. Some of the recent large transactions in the e-commerce sector include a $500 million transaction by Alibaba and SoftBank into Snapdeal, which is one of India's largest online e-commerce platforms. And Alibaba also put in another $500 million in Paytm, which is India's largest online payment services and recharge website. Other sectors which have witnessed significant interest in the recent past are healthcare and pharmaceutical and the insurance sector. Ashutosh mentioned the recent liberalization allowing foreign investment of up to 49% in the insurance sector from the earlier 26% has resulted in a significant amount of interest for existing joint venture partners to increase their stakeholding in their joint ventures. I will wrap up my section by highlighting some of the nuances which are particular to India when doing M&A transactions. The first one is on pricing. Indian law imposes restrictions on the price at which acquisitions and exits can be made by foreign investors. In short, when a foreign investor acquires shares in an Indian company, the price cannot be less than the fair market value. which is calculated by using any internationally acceptable methodology. And when the foreign investor sells his shares in an Indian company to a resident buyer, then the price cannot be more than the FMV. So there's a collar on either side. In case both the buyer and seller are non-resident, then the pricing guidelines do not apply. So there's a fair bit of protectionist measure that the Reserve Bank still applies, where effectively your exit price is capped to what the fair market value determination is by a Category 1 merchant banker. Things like deferred consideration or post-closing escrows or earnouts are something which require prior approval of the Reserve Bank and are viewed fairly cautiously by the Reserve Bank. Approvals have been given in some cases, but the approvals are done on case-to-case basis. Things like put and call options have now recently been given legal sanctity. Earlier, there was a fair amount of ambiguity about the enforcement of such put and call options. Even now, any put and call options which have an assured return attached to such option are not allowed. India has a takeover code, so any transaction with a public listed company where the investor acquires more than 25% triggers the takeover code and requires a mandatory offer to acquire an additional 26% by way of a public offer. Another thing to consider when doing transactions in India, obviously, is dispute resolution, and my partner will talk later about the various issues around white collar and dispute resolution. But typically for M&A transactions, we recommend having international arbitration as dispute resolution mechanism in stock purchase agreements. Venues such as Singapore and London are the most favored, even if the agreements are governed by Indian law. The final issue, which often takes a fair bit of our time, is issues regarding withholding tax in India. And if you have a non-resident seller, there is an obligation under Indian tax laws to withhold tax on the sale consideration. And whether or not a party should, the buyer should withhold tax or not, is often the most debated thing in an M&A document in India. And depending on where the two parties are situated, where the seller is situated, more importantly, and whether or not they have the benefit of treaty jurisdiction, is something which is very critical. So I'll hand it over back to Ashutosh. Thank you.
Thank you, Rajat. Let us now hear from Kabir on some of the key tax issues that investors need to be mindful of. Kabir is a partner in our tax practice here. Kabir, over to you.
Thank you, Ashutosh. This section will be divided into two parts. In the first part, I'll be talking about indirect taxes, which are transactional taxes, and in the second part, I'll be talking about corporate taxes. So moving on to indirect taxes. Any company looking to set up operations in India needs to evaluate the India strategy from an indirect tax perspective. The impact of these taxes is approximately 30% on the value of goods and about 25% on the value of services. Therefore, it is critical to understand and leverage all available structuring options to ensure that tax credits are optimized. The Indian indirect tax regime follows a federal philosophy and is divided between the central and state levies. The central government is empowered to tax imports, manufacturing, provision of services, and interstate movement of goods, while on the other hand, the state government taxes sale and purchase of goods within the state and manufacture of certain specified goods. At a fundamental level, in India, cross-credit of taxes at state and central level are presently not permitted, and this disconnect is responsible for the high impact of indirect taxes. Another issue with the Indian indirect tax regime is that India is a fractured market, and traditionally companies in India have structured their operations based on a rate arbitrage system. For example, a particular raw material may be charged to VAT in a state at the rate of 5% and in another state at 12.5%. The fractured market also increases the cost of compliance. A business typically would file about 20 returns per state in each state of operation. The other endemic issue which makes navigation of the Indian market a bit difficult are exemptions which are available based on the nature of products manufactured and the areas of operation. Though exemptions may seem as a tool to save taxes, however, they create imbalances in the flow of tax credits and in the long term actually do not benefit companies. Another major challenge, and which Rajat already hinted upon, is the litigation risk, which pretty much is faced by all companies in India due to an extremely aggressive revenue administration. So despite there being these challenges, companies still can have certain strategic tools which they can leverage to overcome these. Firstly, we strongly recommend companies to do a detailed tax planning before commencement of business to assess the impact of taxes on sourcing and distribution. In our experience, we have seen that with a bit of foresight, it is possible for companies to reduce the cost of the sourcing and price their products more effectively. Secondly, for companies which are seeking to set up new businesses in India, and if there is an iota of doubt with respect to the tax positions, they can approach the authority for advance rulings and obtain a definitive ruling on the tax position. The authority takes decisions for both direct as well as indirect tax issues, and the advantages of approaching the advance ruling authority are twofold. Firstly, the decision is binding on the tax authorities and the assessee, and secondly, in case of an adverse ruling, the entity can transition its business from the entity which sought the ruling to a new entity. Thirdly, India also has extensive free trade agreement and preferential trade agreements with a host of nations. If a business is being set up in India which requires a considerable amount of imports, these FTAs and PTAs need to be leveraged. Another important consideration to bear in mind are the wide variety of export incentives which are available to companies. For both manufacturing and services concerned, who may have aspirations to export goods or services, these exemptions need to be analyzed in detail. I would also like to take a moment to mention that India is likely to transition into a unified goods and services tax regime, under which no distinction would remain between goods and services. This is the biggest tax reform ever for India, since it would permit cross credits of taxes between state and federal levies and would actually bring down the impact of indirect taxes to about 17 to 18%, which would allow companies the flexibility to either increase margins while retaining prices or price their products cheaper without sacrificing their existing margins. I would now like to take a moment to just highlight some issues and solutions as far as direct tax regime in India is concerned. India follows a source and resident based tax system whereby residents are taxed on their worldwide income and non-residents are taxed on the income sourced in India. The domestic tax laws are governed by the Income Tax Act, and it contains wide source rules for dealing with incomes arising to non-residents. In fact, these rules have gained a lot of international recognition through the Vodafone case, where a transaction between two offshore entities was sought to be taxed in India. After a lot of judicial scrutiny, the position in law has now been settled and is as follows. If the stake of an offshore entity which is being transferred derives more than 50% value from the Indian assets, then the transfer would be taxed in India. There are, however, certain exclusions to this rule, and exposures can also be mitigated using tax treaties, something which Rajat has already alluded to. From a rate perspective, Indian companies are taxed at an approximate rate of 48%, which includes a base rate of 30%, a dividend distribution tax of 20%, and includes a component of cesses and surcharges. Foreign companies, on the other hand, are taxed at an approximate rate of 43%. Certain special rates apply for income of non-residents on transactions which have elements of capital gains, royalty, fees for technical services, etc., and these are usually chargeable at 10%. Another thing worth noting is that the general anti-avoidance rules would come into force from the 1st of April 2017. Once applicable, all investments and transactions will be subject to scrutiny by the Indian tax authorities, and benefits available under relevant tax treaties may be denied if the transactions lack substance. Typically, the major challenges which are faced by investors in India are, firstly, the double taxation on exit. So if a US investor sells its share in the Indian venture, the transaction would attract taxes in India, and since the India-US treaty does not exempt these transactions, the sale of shares would also attract taxes in the US. As already mentioned, the tax administration itself is a complex challenge for companies to navigate and negotiate. And if an issue actually escalates into a dispute, then a company can easily look at a period of about 3 to 5 years for it to get resolved. I would also like to spend a few minutes to highlight a few thoughts which may have a strategic bearing on the India plans. Firstly, investments should be structured to optimizing the tax treaties. Some of India's tax treaties, such as the one signed with Singapore, Mauritius, Netherlands, etc., provide an exemption from Indian capital gains tax on exit from Indian investments, subject to conditions of course. Therefore, investments should ideally be structured through these. However, it is also important to analyze the provisions of the treaty which US has signed with these countries to avoid any leakages of taxes at that level. Secondly, the repatriation strategy should be structured bearing in mind that fees for services are taxed at a lower rate of 10%. An important point to note here is that by having an Indian tax registration number, an entity can avail a lower rate of withholding tax, which otherwise would be 20%. Lastly, advance pricing agreements should also be evaluated since they are an effective mechanism for reducing disputes in relation to transfer pricing matters. APA mechanism enables an agreement between the Central Board of Direct Taxes and any person which determines in advance either the arm's length price or the manner of determination of arm's length price in relation to an international transaction. The APAs have been enthusiastically received by the industry, and they can actually help companies obtain certainty around transfer pricing issues for up to potentially 9 years. Thank you.
Thank you, Kabir. I will now request Sushmit to discuss some salient points on litigation risks and white-collar issues in India. Sushmit is a partner in Khaitan's dispute resolution practice.
Thank you, Ashutosh, Rajat and Kabir. Just to give a brief introduction, the Indian legal system is based on the English common law and has a hierarchical court system. Being an adversarial system that also provides for an elaborate appellate mechanism through to the Supreme Court, court litigation in India is very time-consuming, expensive and uncertain. Thus, our advice is to build into the contractual framework, as Rajat suggested, a robust dispute resolution mechanism, keeping courts' involvement at the very minimum. Arbitration is increasingly becoming the preferred mode of corporate dispute resolution in India. The process is governed by the Arbitration and Conciliation Act of 1996 that is largely based on the UNCITRAL model law. Party autonomy is the defining feature of the Indian law on international commercial arbitration. India has a robust arbitration landscape, both for domestic and international commercial arbitration. The government and courts realize the great importance of speedy resolution of disputes for the international investor community, which is reflected in recent legal developments in making India arbitration friendly and providing for specialized commercial courts. The sweep of public policy definition has been substantially reduced for the purposes of enforcement of foreign arbitral award. With recent ruling in the Balco case, the concept of seat and the principle of territoriality in international arbitration has come to stay. The Indian courts shall not have even supervisory jurisdiction if the seat of arbitration is outside India, including for grant of interim injunction. This aspect has been a little controversial. So, for example, if the seat of arbitration is New York, the Indian courts will not exercise jurisdiction even if the foreign party requires immediate injunction against an Indian party with respect to properties in India. Proceedings for challenging the award also cannot be instituted in Indian courts, though foreign arbitral awards under both the New York Convention and Geneva Convention can be enforced in India as if these are decrees of Indian courts. The grounds for resisting enforcement are as per the New York Convention, and as said earlier, the public policy ground has been narrowed down by the Supreme Court. The issue of interim injunction, however, for foreign seated arbitration is subject matter of legislative debate, and one expects that to be resolved soon. Institutional arbitration has taken deep roots in India, and best practices are being adopted. Increasingly, courts are consciously expanding the jurisdiction of arbitral tribunals to reflect the trend in international thinking on the subject. For example, tribunals' jurisdiction regarding questions of fraud. Earlier, the tribunal did not have jurisdiction to decide issues of fraud. However, now the courts have interpreted that tribunal shall have the jurisdiction to decide issues of fraud as well. That is so far as arbitration is concerned. However, there is another area of concern which the audience would like to know about. We've also seen over the past few years substantial rise in investigations of promoters and key management officers, particularly on the issue of bribery of public servants. Given the heightened scrutiny by superior courts, ombudsmen, and legislative changes, it is of great importance that corporates adopt best practices and put in place risk mitigation measures suited to their business and corporate structure. It is also important to detect frauds early and address them effectively. Businesses now increasingly have to also be concerned of liabilities arising out of data protection and privacy issues. Once an allegation is made, proceedings for criminal liability may be initiated. For enforcing criminal liability, promoters and key management officers will be investigated for the alleged offense, for example, fraud, bribery, conspiracy, etc. They are at substantial risk of losing personal liberty. Example, restrictions on foreign travel, arrest, search of their premises, deposit of passport, etc. After the investigation is over, there typically is a trial at the lower courts. Additionally, proceedings for attachment of proceeds of crime and prosecution for the offense of money laundering can also be initiated. Money laundering prosecutions are gathering momentum in India, and almost all bribery proceedings are leading to prosecution for money laundering. There also have been proceedings initiated in India on account of disclosures made by foreign companies in the parent jurisdiction regarding bribes paid in India. There's another area that investors need to be mindful of. Allegations of wrongdoing typically also trigger proceedings for fixing civil liability. For enforcing civil liability, the government agency involved will typically initiate blacklisting proceedings and may also cancel contracts and initiate damages claim. To get immediate relief, courts are the only option. In these cases, the courts are very sensitive, particularly in areas such as defense, to grant immediate relief. Cases are also known where courts grant permissions to participate in tenders, subject to the outcome of administrative proceedings, which are taken out for blacklisting the firm in question. To sum up, as Rajat said, the audience has to bear in mind the above risks while firming up their India-centric plans. Over to you, Ashutosh.
Thank you, Sushmit. Let us now start the panel discussion part of this webinar. First question to you, Rajat. What are the regulatory challenges involved in investing in an existing company, whether public or private, in India?
Well, I think there's two things. One is that, as I mentioned earlier in the first slide, whether it's a public company or a private company, I think the regulatory challenge really comes from whether or not, which sector that company, what work that company is engaged in. So if it is a company which is engaged in a sector on which where there are caps on foreign shareholding and ownership, then you need to go through an approval process of the FIPB, or the Foreign Investment Promotion Board, as I mentioned earlier. So as far as a pure public or a private company is concerned, there are no real differences between the two, other than the fact that obviously a private company has significantly less compliance and disclosure regime that it needs to comply with as compared to a public company, and especially a public listed company, which is obviously then governed by the Securities Exchange Board of India, or which is the equivalent of the SEC in India. So that's the short answer to that question, Ashu.
Thank you, Rajat. Let me direct the next question to Kabir. Recently, there was a controversy on the applicability of minimum alternate tax, or MAT as it is widely known, on FIIs in India. Could you shed some light on this?
Sure. So as you mentioned, MAT stands for minimum alternate tax and is payable by companies on their book profits. The controversy was centered around the fact that when FIIs were seeking to exit from their India ventures, the revenue authorities sought to recover MAT based on the interpretation that the Income Tax Act did not distinguish between Indian and foreign companies, and accordingly, foreign companies should be required to pay MAT on the profits made on such exits. The issue also stemmed from the fact that several FIIs were claiming treaty benefits and were not required to pay tax on the capital gains incurred on their exits. Interpretation taken by the revenue authorities was actually in direct conflict with the Indian corporation laws, which did not require foreign companies to maintain books of accounts in India. Based on the backlash, the government constituted a committee under the chairmanship of retired Justice A.P. Shah to examine the issue of applicability of MAT on FIIs as well as foreign portfolio investors. The committee recommended that MAT should not be applicable to either FIIs or FPIs, and the suggestion was actually accepted by the government, and the law has now accordingly been amended to clarify that the tax would not be applicable either prospectively or retrospectively.
Thank you, Kabir. Sushmit, can you help us understand whether a corporation can be held criminally liable under the relevant Indian laws?
So Ashu, earlier there used to be a controversy about whether a corporation, a fiction in law, can be held criminally liable. And criminal law, as traditionally understood, was understood to apply only to individuals. However, under Indian law, this issue has been settled by the Supreme Court. In Standard Chartered case, the Supreme Court clarified that corporation can be guilty of crimes and can be prosecuted as such. For purposes of mens rea, which is the requirement of intent, the conduct of responsible officers are taken into account on the doctrine of attribution. Typically, the corporation has to appoint a representative, not an accused, for purposes of trial, and the corporation is prosecuted through the representative, so there is no personal liability of the representative. Of course, there is not going to be any jail term for the corporation, but however, the penalty prescribed under law will be the punishment given to the corporation. Thank you.
Rajat, why are assured returns not allowed on buybacks or exits to non-resident investors?
That's a good question, Ashu. I think as most people are aware, I mean, for most private equity investors, one of the key things that they're concerned about and they protect is the assured return that they want on their investment, whether it's as a percentage or a multiple of the IRR, or using various other methodologies to calculate what that return ought to be. In India, the Reserve Bank views such assured return covenants or obligations as something which is akin to debt, because effectively their view is that if it's an equity investment, the investor should take the risk associated with such equity investment, and any kind of an assured return smells like debt, and if it's debt, then it ought to comply with all the limitations that come with the external commercial borrowing guidelines. So which is why they don't allow assured returns. Having said that, there is still a fair amount, I mean, as far as transaction documentation is concerned, a lot of the private equity investors are willing to take that regulatory risk and still insist on some kind of assured returns in their documentation. However, if it comes down to actually enforcing it before a court of law, I think it's going to be very challenging.
Thank you, Rajat. Kabir, could you please elaborate on the advantages of setting up operations in special economic zones here in India?
Sure. If the export potential of a product is clearly known, a company could set up an SEZ for essentially 4 reasons. Firstly, all approvals which are required to set up the unit can be taken from a single governmental agency. Secondly, apart from the regular concessions and exemptions which are available to manufacturers in due course of their operations, the SEZ scheme also allows manufacturers to enjoy an exemption from taxes imposed on utilities. Thirdly, all compliances are required to be filed with one nodal agency, which also reduces the chance of there being a gap in compliances. And lastly, from an operational perspective, the clearance of goods from an SEZ are taken on priority. Therefore, if delivery schedules are critical, this could be a significant advantage which should be available to a company. I would like to add that with the thrust on manufacturing sector in India, under the Make in India initiative, it is expected that activity within SEZs is likely to pick up, considering that states are now offering better infrastructure and also cheaper land to set these up. Thank you.
Thanks, Kabir. Sushmit, this next one seems right up your alley. Can the promoters or key management officers of companies be arrested for allegations of bribery and other allegations of similar nature?
So, Ashu, under Indian law, and as I understand the question to mean, is that supposing that there is any officer or any employee of the company who's involved in, say, an allegation of bribery, the question then is that whether it travels up to the promoter or key management officers. So, under Indian criminal law, the concept of vicarious liability is not there. However, it can be statutorily provided. The key officers, therefore, can be arrested, investigated, and, if guilty, convicted. The courts have indirectly tried to rope in the promoters in cases where the statutes don't provide specifically for their liability by charging them, say for instance, for criminal conspiracy to commit offences, say bribery, or through the route of abetment provided under the Indian Penal Code, which is the main criminal law of India. The shield of corporate veil is not available in criminal law, and therefore these officers are certainly at the risk of being arrested, and our past experience has been that they are being arrested, some of the most high-profile cases. I think that answers the question, Ashu.
It does, Sushmit. Thank you. Kabir, let me ask this next one of you. Could you elaborate on whether sale of business would attract any VAT implications?
Sure. So a sale of business as a going concern is usually not chargeable to VAT or any indirect taxes, since indirect taxes are transactional taxes. The critical thing to note is that for a sale of business, all assets and liabilities of that business should be transferred from the seller to the buyer. However, if assets are cherry-picked and sold, VAT would be applicable, and the seller would be required to discharge the liability at the applicable rates. I would like to add that even sale of individual business units or divisions would not attract any VAT if all the assets and liabilities of these business divisions or units, as the case may be, are sold. I hope that answers the question.
And just to add to that also, I mean, this also goes back to the point I was making earlier about transaction structuring. Now, whether or not you do a transaction on a standalone asset transfer, or whether you do it as a slump sale, is often determined by the asset class that company has. So if it is a company which has significant immovable property, then it might be better to do it on a slump sale basis versus an asset deal if it has significant other movable asset which can be just transferred by delivery. So a lot of these things are things that need to be thought through when you are structuring a transaction. And the other thing with slump sale, of course, is whether that entire undertaking itself can be construed to be an undertaking under the tax laws for it to get that benefit that a slump sale gets under tax laws.
Thank you, Kabir and Rajat, for your thoughts on this. Given that transactions involving deferred considerations require prior FIPB approval, how do deals account for this in transaction documentations? And how long does it take to obtain an FIPB approval? Rajat, I think this one is for you.
Yeah. So, like I mentioned during the presentation, deferred consideration, where you have a foreign investor acquiring shares from, let's say, an Indian seller, where a promoter is selling, let's say, significant majority to an incoming investor. Let's say there's a valuation discussion between the two. It's fairly common in most jurisdictions to have a structure where you find a valuation that both parties are agreeable on day one, and then basis certain milestone being met, and certain projections coming true, a certain deferred piece or an earn-out is structured where the payment comes for the same transactions comes in a few years' time. The Reserve Bank in India views any kind of these deferred structures as something which interferes with the inflow of foreign exchange in the company, and so it requires any kind of deferred payment or earn-out structure requires prior approval of the RBI. The recent cases that we have seen, as long as the initial payment being made to the Indian seller is higher than the fair market value of the shares, the RBI has allowed people to do deferred consideration structures. One way of trying to compress the timeline, because if you want to do deferred consideration, you need to go and get approval. One way to shorten the time frame is to structure the transaction slightly differently, where instead of buying, let's say, the 51% that we want to buy on day one, we buy 50.9%. And leave some shares in the hands of the Indian promoter or the seller, which are then bought a year later or 2 years later when we want to pay the earn-out amount or the deferred consideration amount, and to really show this as a share transfer as opposed to a deferred consideration being paid. And this kind of a structure is fairly common, and it is also tax neutral from a capital gains perspective. And if anything, it defers the capital gains in the hands of the Indian seller to 2 years or a year down the line when he actually receives the consideration against the share. So there are some structures that people have done to effectively structure deferred payment, but not go down the approval route.
And what if the Indian promoter refuses to transfer that 0.1 share in your example?
He has a lot of money riding on that, right? I mean, it doesn't take away the control that I have, that I wanted to achieve on day one with a 50.9% as opposed to a 51%. But it's really a mechanism to facilitate the payment of the deferred amount.
Understood. Thank you. Sushmit, is it routine for courts to question executive decisions that were taken perhaps several years ago?
So, Ashu, this is not routine, but recently, last year in September, the Supreme Court actually cancelled all coal leases granted by the Government of India since 1993 till then. There was there's no precedent for that the court went that far, but there were allegations of large-scale wrongdoings, and the court sort of took the public interest into account and cancelled all the coal leases. The principal ground was that it was done arbitrarily. Not only that, the court also directed penalty to be paid by the beneficiaries on the basis of coal earned. Also, the court cancelled the spectrum licenses granted by the telecom minister arbitrarily. Cases typically where there is large-scale abuse of power, the courts tend to ignore the time dimension. But normally, they are mindful of the issues of predictable executive action.
From what you're saying, it is best to try to mitigate these risks by undertaking your India entry or any of your India plans by using above-the-line measures as far as possible, and to stay away from all of the trickier structuring aspects. Is that what you're saying?
Oh, absolutely, by all means. That's very important.
And does the highest court of India, which is the Supreme Court, regularly exercise such appellate jurisdiction?
So two things to that question. As contrasted to the U.S. Supreme Court, which sits as one court, 9 justices, the Supreme Court of India, though a constitutional court, it sits in divisions, and it wouldn't surprise the audience, but it sits in division and has almost 14 benches. Typically, on a Monday or a Friday, which is called the miscellaneous days, each bench has about 60 to 70 matters where parties seek leave to appeal. Because of this, and this practice being very old, huge pendency in the Supreme Court, and Supreme Court tends to grant leave in lot many appeals than you would expect a U.S. Supreme Court to do. So the docket of Supreme Court is really exploding.
Thank you, Sushmit.
Which explains why people want to do national arbitration instead of going to courts in India, given the significant delays that you have, given the amount. The judiciary is overworked.
That's correct. That's so right, and that the audience has to be mindful of.
Sure. Kabir, could you please elaborate a bit more on GST? We spoke about the upcoming, rather I should say imminent goods and services tax, and it'd be interesting to know your thoughts on this.
Sure. So as I mentioned, at a high level, GST removes the distinction between goods and services and treats them at par. This is supposed to benefit the manufacturing companies the most, since it would provide cross credits between state and federal taxes, which was not permitted thus far. As far as services are concerned, they were not chargeable to any state taxes. Hence, GST would actually increase the present tax on services. Secondly, as I mentioned, under the existing taxation regime, any manufacturing and distribution activity typically faces approximately 30% transactional taxes, of which there is a blockage of approximately 14 to 18% on account of non-creditable levies. And this translates these non-creditable taxes being recovered from the eventual customer. GST is a tool which unlocks all uncreditable taxes from the supply chain, which would result in reduction of the overall product cost to the customer. The other significant advantage of GST would be the reduction in compliances. As I had mentioned in the presentation, for each state of operation, a business is required to fill and file about 20 returns in a year. With the advent of GST and a centralized compliance mechanism, it is expected that the compliances are going to be significantly reduced, since all the states in the country would be able to access a common database to track the flow of goods and services. However, there are also several challenges which would need to be addressed, especially for companies with existing operations, such as how will they factor the transition credits, the ERP redesigning, the relocation of suppliers, etc. GST is set to create a common Indian market and will be a game changer of sorts. Even though its official rollout is some time away, companies should ideally start thinking ahead in order for them to be able to optimally leverage this opportunity with minimal disruptions to their existing businesses. Thank you.
Rajat, what is the appetite of Indian companies for outbound transactions?
I think the appetite is definitely there. I think the Indian Reserve Bank has in the past put some restrictions in terms of the amount of money that Indian entities can invest outside India, given the precarious foreign exchange problem that India saw a few years back. Some of those restrictions have now been relaxed, so an Indian entity can invest up to 400% of its net worth in an investment outside India. And because of these relaxations, we've seen a fair bit of increase and uptake in the number of investments that Indian entities are doing outside India. These are primarily driven by the need for technology, and the need for natural resources. So there's been a lot of most of the transactions that we have seen have happened in either going to acquire coal or shale gas or other natural resources, and on one hand, and then looking at filling in gaps in technology needs that Indian companies have. So a lot of investments which have gone into Europe, especially, and even the United States, have been driven by these two sectors, I would say. The other area where Indian companies have in the last few years really taken to is investing in Africa. I think Africa as a continent is something that has seen significant interest from Chinese investors, and I think India has been slow to the game, but I think that they're definitely interested in making their presence felt in Africa.
Thank you, Rajat. I think we are now approaching the end of this webinar, and I would like to thank everyone, the panelists as well as the audience members, for their time. Thank you.